I should say, first of all, we're delighted to be principal sponsor of this conference again. We were here last year, thought it was a really excellent day, not just because of the insightful conversations on the stage, but those particularly in the breakout areas as well. Some really engaging views expressed and shared amongst CEOs and funders alike. So we're really pleased to be here again. I was particularly interested in the millennials presentation, and I'm wondering whether the fact that I'm also not particularly confident about how to use a washing machine makes me an honorary millennial, perhaps. We live in hope. We have a millennials board at Santander, a group of our graduate intake who advise the senior leadership team on how millennials like to interact with banks, the products that they use. And one thing that came out of that conversation was that none of them expected to work for the same organisation for more than 5 years, which made us really think about how we fund our graduate programme and training and development beyond that. Anyway, a number of themes I think will come out in the fireside chat that I do shortly with my guests, both of whom are really standout portfolio companies of mine, particularly I think around the importance of social media with Aspinall of London, the importance of experiences for millennials and beyond with Spectrix. We'll hear about all of those things and a number of other factors that are really relevant to high growth SMEs. Before that, though, just a few slides from me to set the scene about what we're going to be talking about, a little bit about funding, and then we'll move on and hear from the first of the CEOs today. So this is one of my favourite slides. I've been using this slide for years. I've got no idea who wrote it. I can't credit it to anybody. But it's a really good summary of the different ways of funding growth at various stages. So at the bottom there, you'll see bank finance, and that's the lowest risk, lowest return, but is very flexible, moving from small deals to large deals. You know, that might be things like funding the move to larger premises, funding the acquisition of new capital equipment, largely secured deals, so low risk, low return, but very flexible. And then if we move up the left-hand side there, so smaller companies, but probably younger companies, maybe pre-revenue even, certainly probably pre-profits. There might be some grant funding available, particularly if there's a growth in employment in those scenarios. But as you move up, still a small business, into real investment in growth, investment in overheads, having an impact on profit and probably cash, especially if there's investment in capitalized development costs. Really, you're looking at business angels who are going to be seeking a particularly higher return. As you move across the top, deals get bigger, but still very much an equity risk. And eventually you move into that private equity space, and a number of practitioners are here today. Where we positioned ourselves at Santander Growth Capital was very much in the middle. It seemed to be a big empty space, and entrepreneurs that we were talking to wanted something that wasn't really there in that segment, and without really knowing what it was, it was a simple mezzanine type product where we take a view on the cash flow that companies are generating as opposed to the assets that they have, the value that they're creating, and we introduced, this is 6 or 7 years ago now, a different kind of debt product that would position businesses so that they could grow, so that they could get to that almost inevitable point at which they go down the private equity route, but owning more, if not all, of the equity themselves. Valuation, if you're a CEO and a founder, you'll know how important that is. In terms of what growth capital really is, and we'll hear a lot about it today, and it's not just about funding, but it's a funding package that is very flexible, that can be applied to lots of different areas. And just, the way that I split that in my mind is into development capital type projects, and then M&A type projects, both of which have the key value creation objective at their heart. So in terms of development capital, it could be as simple as investing in people. You know, that's critical, and we'll hear some more about that from Aspinall and from Spectrix in a few moments. And those people might be in sales and marketing. They might, it might be a finance director. As a founder entrepreneur, you'll get to the point at which you realize that you can't do everything on your own. You have to bring in additional talent. But that costs money. It will hit the P&L before there's a payback. And that requires a certain type of funding. Research and development, new product development. You will know that businesses that stand still are not the ones that are going to succeed in the long run. And overseas expansion, the research that we've done at Santander shows that businesses that trade across different markets ultimately are much more able to withstand headwinds that come at them in one of their core markets. So, this is something, again, that is common to both of my guests, and we'll explore in a little bit more detail shortly. But also the M&A side, whether that is strategic acquisitions and the value there, along with buy and build strategies coming particularly from delivering operational synergies and from cross-sell opportunities, value still very much at the heart of those deals. Shareholder restructuring I've put there, an example of those kind of deals that we do from time to time might be where we have two or more founders who create a business that is defensible, that has significant growth potential, but there's a divergence of interest. Some of the individuals will want to go on and invest and grow that businesses, and others will want to realize what they've already achieved. And by having a mechanism of exiting one or more of those founder investors, the value can go on to be created. Succession planning, very much a part of that as well. And management buyout, something we've moved into more and more, but a little bit more about that in a moment. Here's quite a busy slide. You can tell that it's not mine because it's blue rather than red. Everything we do is red. But we had this slide last year put together by PitchBook for the BVCA, and I thought it would be interesting at least to have a look at what happened throughout the rest of 2017 in the market and into 2018. This is comparing growth capital deals, probably equity deals if I'm being honest, in the US and in Europe. And you can see that the US is a bigger market, but that Europe is following a very similar trend. And actually the deal sizes are converging. US deals typically have been the equivalent of 9 to 10 million pounds each. Europe 4 to 5 million, but that gap is reducing. There's a clear trend through there of growth, irrespective of what comes along and hits the market. 2016 saw a drop first in the US and then in Europe, but 2017 very robust year. 2018 following that trend. And if we overlay onto that some research that is done by Kingston Smith on equity investment deals between 1 and 15 million pounds, 2017 saw significant growth over 2016. I think it was something in the region of 416 deals done as opposed to 321 the year before. 1.7 billion invested as opposed to 1.4 the year before. I think, though, we don't have to be too insightful to know that there's a lot of money out there looking for the right opportunities, and probably a third of the audience today are CEOs. The other 2/3 a mix of advisors and investors. So if you are a CEO, you have a growth plan, you expect that will need some funding to deliver it. You won't be short of hawkish eyes looking to identify you in the bar later. Hopefully you'll have a good opportunity to explore some interesting potential routes. And then, because we are principal sponsor, just a few words about us. The top left there is just a split of the sectors that we've invested in. It's interesting that technology accounts for about 10% of our activity. Maybe that's because launching new products, new services, new software requires a fair amount of upfront cost ahead of commercializing it. I think in the market you probably would see 20%, maybe just a bit more than 20% of growth equity investments being in this space. But there are winners in every space, in every part of the country, and we're delivering our growth capital product not just here in London, but on the ground in all of the regions. We're doing more and more with private equity. When we started, we were solely backing entrepreneurs, but last year, almost half of what we did was working alongside private equity or venture capital trusts, and so probably a third of our portfolio now is in that space. Over the 6 years that we've been doing this, we've done very nearly 200 deals. We're just waiting for that 200th now, hopefully not many weeks away. And that's averaged, probably £100 million of debt capital a year. What's also interesting is that those deals have facilitated another 70 million of additional private sector investment, either from private equity or elsewhere. And it's allowing the businesses that we're lending to create a significant number of new full-time jobs. And in terms of the kind of businesses that we're looking to support, I mean, you'll hear from two of them very shortly now. We don't have a long tick box by any means. We're looking for exciting, growing businesses that have been operating for 2 or 3 years, have established a demand for their products. They are profitable on a core underlying basis and have a management team that we think can go ahead and deliver more growth and more value creation.